Hi, good morning, everyone. Welcome to Tax Chats. My name is Scott Dyring, and I'm happy to be here with you today to host the third Tax Chats in the last 3 weeks, where we are talking about different proposals that have been floated in Congress related to taxation. And today, what we're going to talk about is retirement savings and some big changes that have been proposed with regard specifically to Roth IRAs, but they might also have pretty significant influences on other types of retirement savings accounts. Here's what, let me start by sharing real briefly an article that you may have seen. I probably did see, or maybe have heard about if you didn't see it. And it's this article here. I'll share my screen. And what you can see is, so it's called Lord of the Roths. Okay, so ProPublica was the recipient of a large leak of data from the Internal Revenue Service, and they're using this data to expose many tax issues, one of which is apparently some extremely wealthy individuals have IRA accounts, including a Roth IRA owned by Peter Thiel, which is worth $5 billion. Okay, and it's a very large amount. And I'm not going to kind of read through the article, but just to kind of tip you off, the controversy around these types of things then grows large, because it seems sort of unreasonable or unbelievable that an individual could have an IRA balance which is that large. As a consequence, these articles have increased the desire in Washington, at least among some, to change the rules related to retirement savings so that nobody can have an IRA balance that's $5 billion. I think to really understand what's happening here, we probably need a little bit of background. And some of the background can be a little bit tedious and a little bit algebraic. And so what I'm going to do is I'm going to share my screen, and I'm going to give you a little bit of algebra. And I'm also going to give you just some numbers in case you dislike algebra greatly. And as we go through this, I hope you'll feel free to jump in with any questions. You can chat them. In fact, I better open the chat in case I don't have it. Chat in your questions, or you can just raise your hand or just really unmute yourself and shout out, and be happy to take any questions that you might have as I go through this. And then we'll talk about the implications and what the new tax laws would be. So once again, I'm going to share my screen, and I'm going to flip over to a OneNote file where I'm going to take a few notes. Okay, so let me just arrange my things here so I can see you all in case you choose to ask a question while I'm doing this. So let me give you just a little bit of background. The first thing is, let's just assume that one wanted to save in a savings account. This would be like the old school way of saving, or what you might do with your kids when they turn 14. You say, hey, you should start saving. Let's go down to the bank and we'll open a savings account. If you did that, you might take a certain amount of dollars. I'm going to call those dollars I, the amount of dollars that you're going to invest. But those dollars are really pre-tax. So if you work and you earn I dollars and you want to save those dollars, you can't just save them if you're going to put them in the bank. You first have to pay taxes at your personal tax rate. That's the personal tax rate. So if you're fairly wealthy, that might be 35%. If you're poor, it might be 15%. But you pay your personal taxes. So you're only left with one minus your tax rate in terms of dollars. Then you put that money in the bank, and it grows at whatever the rate of return is that the bank pays you. But it doesn't really, because when the bank pays you interest, you have to pay tax on that interest every year. You get a little form from the bank and you pay taxes, and then that grows for N years. And that, when you you know, after N years, say 40 years or something like that, that's how much you have. Now, if you don't like algebra and you don't like to think about that, here's the way this would work. If you used a 10% interest rate for R, if you had $1,000, this $1,000 would grow to become $8,000, $8,070 to be exact, in 40 years. Okay, so that's great. And that's the lesson you might want to teach your children. Hey, if you save money, instead of having $1,000, you'll have $8,000. Well, over the years, the government has thought it would be a good idea to subsidize the savings of people who want to use those savings for purposes of retirement. And so kind of initially, what's now known as a traditional IRA or individual retirement account was created. And an IRA works as follows. You take your I-dollars that you have, but instead of paying taxes like we did up above, you don't have to pay any tax. You just take those I-dollars and you invest them, and they grow at the rate of return, whatever the rate of return is. And they grow like that without any taxes in that account for however many years you invest them for. It might be 40, could be a long time, could be 30, depends on how early you invest and when you retire. And then when you retire and you start to take that money out of your account, then you pay tax at the on the distribution, okay? And if you do this, your $1,000 will grow not to be $8,070, but instead to be $29,419 in 40 years. Okay, and so what's the difference between 8,000 and 29,000? Well, obviously it's a big amount, but what's happening is you're not paying as much tax as you otherwise would, and because you don't pay those taxes, your retirement grows much larger, and even after you pay all of the taxes that you owe, your retirement is still better than it otherwise would have been. Okay, all right. Now it turns out that another type of retirement account called a Roth IRA was introduced in the late 90s. Roth was the name of the senator from Delaware, I believe, who introduced or sponsored the legislation. And a Roth IRA works like this. You take I-dollars, but instead of contributing those dollars with a tax deduction, so before tax dollars to your account, you have to pay tax on them. So I'm going to pay tax now at whatever my tax rate is, and then I'm going to invest them for all those years. But when I retire, I don't have to pay any taxes. I get to withdraw the income from my account tax-free, the savings from my account tax-free, and I don't ever pay taxes on those. I paid tax up front, I don't have to pay later. Well, if you like to think about math, what you can see is these two equations are exactly the same if the tax rate is the same when you retire as it was when you invested. They're the same thing. As a consequence, $1,000 invested now will grow to be $29,419 in 40 years. Okay, they're the same. Well, so what's the controversy? The government did not intend to subsidize the retirements of the super uber wealthy. They intended to subsidize the retirements of those who might be struggling, or maybe the average person, but not like a billionaire. So these subsidies have been, so in order to make that clear, when Congress created the rules for IRAs and traditional IRAs and Roth IRAs, they created income limits. And those limits are something like this. When you invest in a traditional IRA, you can only invest $6,000 a year, or if you're married, each spouse can contribute $6,000, so a total of $12,000. And you get a deduction for that IRA on the contribution, but only if you make less than about $75,000 if you're single, or about $206,000 if you're married. If you make more than those amounts, you can contribute to the IRA, but you don't get the deduction. If you don't get the deduction, the big subsidy that the government is giving you, most of it goes away, okay? Likewise, with a Roth IRA, there are limits. So the same thing, 6,000 and 12,000, but if you make more than 140,000 if you're single or 208,000 if you're married, you cannot contribute. You're prohibited from contributing. So those were sort of designed to say, we want to subsidize savings, but the people who are sort of wealthy, we don't need to subsidize their savings. So we're going to put some income limits on these issues. Well, people are clever, and they figured out a way to get around these income limits. One of the ways that they figured out how to do this was through something called a backdoor Roth IRA. So how does that work? Well, I'm going to share my screen one more time with you, and I'm going to show you kind of the simple version of how that works. If I take this IRA, which I'm going to call now a non-deductible IRA, and I'm going to call it non-deductible because suppose you make more than the limit of, $200,000 approximately. You can still contribute to your Roth, but you don't get the tax deduction. What that means is if I'm comparing this one to this one, I would take I dollars, but instead of not paying tax up front, I'm going to have to pay tax, something like this. Then I invest and it grows for however many years. And then I will have to pay tax when I take it out. Now there's actually this gets a little more complicated here because I have to add in a little thing for what's called basis. But ignore this for now. I'll just write it here in case you want to be technical. But what you'll notice when I think about this is here I have to pay taxes up front and I have to pay taxes at the back end. And that's not nearly as good a deal as only paying taxes on the back end like the traditional, or only paying taxes up front like the Roth. I have to pay at both ends. It's not as good. Well, here's what you can do if you're very clever. You can contribute to your non-deductible IRA, and then you can convert this to a Roth. And when I convert it to a Roth IRA, what then happens is I am taxed like a Roth IRA, which means I won't have to pay tax on the back end. If I don't have to pay tax on the back end, I get rid of this term, I get rid of this term. And now what you can see is I have manufactured something that looks identical to the Roth IRA, but I have circumvented the income limits, which means anyone with any amount of income can still contribute to a Roth IRA. Okay, so that's like a very brief background. Let me give you a couple of little tips, okay? Many of you are now working and you're making money and you're very likely reaching those income limits, or you could be, or maybe someday you will, okay? If you're still a student, or maybe you don't make that much, but maybe you hope to. If you start making more than $200,000 a year and you want to contribute to a Roth IRA, the backdoor Roth currently is completely legitimate. You can contribute to a traditional IRA, you can then convert that IRA, but here's the one caveat. There's a super important caveat. You must pay taxes on any gains in your IRA when you convert to a Roth. And that's not a problem if you didn't ever have an IRA and you contribute to the IRA and then flip it over immediately, because in the short amount of time it takes you to contribute and then flip, you won't have any gain to worry about. So there will really be very small tax consequences. On the other hand, if you have worked for many years and have a very large IRA balance or whatever it might be, and there's a lot of gains built up in that, and then you contribute to a new non-deductible IRA and you want to convert, you can't only think of the gains in the new amount that you just contributed. You have to take the average amount of gains over all of your IRA and pay tax on some portion of that when you convert. So there's a little bit of a caveat to this backdoor thing. It only works if you don't have a lot of gains built up in your traditional IRA accounts, okay? All right, so the backdoor Roth has gotten a lot of scrutiny because it's allowing people to circumvent the rules, the income limits on IRAs. It turns out that Peter Thiel did not circumvent any rules. What he did was just buy shares of PayPal, I think, when they were like worth nothing. And then PayPal became worth like lots and lots of money. And he had lots and lots of those shares because he spent $2,000 to buy a lot of shares, even though they were worth nothing. And now they're worth billions of dollars. So it wasn't an income limit issue. It was, he got like super lucky. And in part, he got lucky because he had access to purchase those shares before PayPal went public. But you and I typically don't have that access. And if we do have that access, it's actually fairly complicated to do in your IRA. You can't put your money in Fidelity, your IRA, and then just waltz over and buy like some, you know, company that hasn't yet gone public. You typically end up buying things that are publicly traded. So the government doesn't like that. And there's pressure now to change the rules so that the Peter Thiels of the world can't take advantage of the IRA tax breaks when what they're really doing is saving and making tons of money. Now, I kind of was curious. Suppose you had had a lot of foresight and you could only have purchased something like a publicly traded stock in your 401k. So I thought, let's suppose I had been a really good investor. I got married in the year 2000, in December. So let's suppose that my wife and I decided, hey, we should buy some stocks in an IRA the month after we get married, January 2001. If we did that, and I had excellent foresight, I could have purchased shares of Monster Beverage, and they would have cost me 8 cents per share. Oh, I'm not sharing my screen, so let me show you this so that you can kind of see. Well, actually, I don't need to show the screen. I'll just tell you, I could have bought shares of Monster for 8 cents a share in January of 2001. The income limits for IRAs at that time were $4,000 if you were married. So I could have bought $4,000 worth of Monster, which would have been 50,000 shares of Monster. As of now, Monster shares are worth something like $90 a share. So my $4,000 of investment, if it was done in a Roth IRA, would now be worth $4.5 million. And the great thing about that is if it were in a Roth IRA, the withdrawals from that when I retire would be tax-free. So I would have a $4.5 million nest egg sitting there from a $4,000 investment, which would give me tax-free income in retirement. Now, unfortunately, I was not that wise, did not buy that, but people can get lucky. And when they get lucky, their investment balances can grow unusually high, okay? And at some level, that maybe is what happened with the extreme case that we see of Peter Thiel. All right, so what does Congress want to do? Well, Congress wants to do the following things. First of all, they want to disallow contributions to any IRA if the total balance in your IRAs, Roth and traditional, and your 401k or your 403b if you work in a nonprofit, all of those tax advantage savings accounts sum all of the balances. If they're greater than 10,000, then no contributions to an IRA. Okay. Now that's only going to be true if your income is also greater than 450,000. So if you're making pretty good money and you've managed to save a decent chunk of change in all of your retirement accounts, you will be ineligible to contribute to an IRA. The second thing is they want to implement reporting requirements so that every employer must report to the IRS the details of accounts, retirement accounts, so there's like your 401k, if the account balance is greater than 2.5 million. So that's going to encompass quite a lot of employees that companies that pay, maybe something like $150,000 or $200,000 a year. Many of you who get an MBA might be working in companies like that. It's not unreasonable to think that your 401k balance over 10 or 20 years could grow to be $2.5 million. And when that happens, the IRS will be receiving a report from the employer that says, hey, you have a retirement account that's 2.5 million. The next thing they want to do is require what are known as minimum distributions or required minimum distributions from your retirement accounts. Those currently exist for traditional IRAs. Once you reach a certain age, you must take a certain amount out of your retirement account and use it every year, or at least pay taxes on it every year. Those rules are less stringent for Roth IRAs, and the new rules would say something like this. If your IRA has a balance of $10 million, then you are required to distribute to yourself and pay taxes on 50% of the amount over $10 million. So if you had an $11 million balance during that year, you would have to distribute to yourself $500,000 of gains. You would pay taxes on those gains, and then you could keep the remaining there. Once your balance hit $20 million, you would be forced to distribute to yourself money up until you got down into the $10 million range. 100% distribution until you got down into the acceptable range between 10 and 20, and you have to pay tax on that. So the point of those tests would be to prohibit or not allow people to accumulate really, really large tax-deferred or tax-free balances, and instead require those individuals to make distributions to themselves where the income would become taxable and then pay tax on those amounts, okay? The last thing that would happen is you would not be able to invest in any kind of investment that requires some kind of an income test, okay? Now, what do I mean by that? Well, Peter Thiel probably was only able to invest in the shares of PayPal early on. Is PayPal or eBay? I forget which one, whichever it is, okay? Because he was only able to do that pre-IPO because he was what's called an accredited investor. An accredited investor is someone who has income over the last 2 years of at least $200,000 a year, or assets of $1 million in their net worth. Okay, you have to have net worth of $1 million. The government doesn't want to allow people who have special investing abilities that are based on their income to be able to use those special abilities to invest in a tax-favored way. So this proposal would eliminate the ability to do that. You could only invest in things that everybody else can invest in. Okay, so these new rules would significantly affect IRAs. You might be thinking, it's not going to affect me. I don't have $10 million in my IRA, and I'm never going to have $10 million in my IRA. The only thing that really concerns me about this is this was also sort of the logic behind something that was known as the alternative minimum tax, which was originally designed to place a higher tax rate on a relatively small fraction of the population, like, the top 0.1% of income earners. But over many years, it started capturing more and more and more people until really pretty much typical earners were paying the alternative minimum tax, especially if you had, say, for example, lots of kids like I did. So I had lots of kids. I'm not earning that much money. I mean, I'm not poor by any means, but I'm not like raking in the cash. And it was forcing me into this world where I had to pay extra tax because of a rule that was designed to capture the incomes of the ultra wealthy. Once you start changing these rules, it is possible that the amounts could easily become commonplace if we have significant amounts of inflation and so forth. Now, maybe these things will be indexed for inflation and that will not be a problem. Time will tell. What are some alternatives? You might want to think about, well, let me back up. Nothing has changed yet. So if I were you, I would continue contributing as much as I could to these tax subsidized retirement accounts. IRAs, Roth IRAs are amazing ways to save. And if you can invest in them, it's certainly better than just putting your money into Robinhood and trading stocks, okay? Second thing to think about is there are other alternative savings that you might want to consider. So for example, you might qualify for what's known as a health savings account. If your insurance has a high deductible, you probably qualify. If you qualify, you can invest your dollars pre-tax. Those dollars grow without paying tax in the account. And even better, when you use those dollars, you don't have to pay tax if they're used for qualified medical purposes. So if you get old and you're, need a lot of healthcare, like a lot of old people do, you get a really huge benefit from using a health savings account. If you end up not needing them for healthcare purposes, you can take withdrawals and you pay tax at your rate. If you're over 65, there's no penalty, and it's sort of like having an additional Roth IRA. You might also think about this. You could go to Robinhood, and if you buy shares in some stocks that don't pay dividends, you will essentially be deferring a great portion of your tax until you sell the shares. Or better yet, you can hold the shares until you die, in which case your heirs can step up the basis in those shares and they don't pay tax, and you avoid the tax like forever. Alternatively, you might be interested in saving for education, for your kids, for your grandkids, for somebody. You can invest in what are known as 529 college savings plans. Those also have tax advantage characteristics. And there's other ways you can save in tax favored ways. So real estate is commonly known as a way to invest in tax favored assets. It gets complicated and we could spend some time thinking about that, but today we don't have time to cover the details of real estate taxation. Okay, that gives you a little bit of background and a little bit of understanding of what's going on in the retirement savings world with regard to 401ks, Roth IRAs, and so forth. Does anybody have any questions? I'd be happy to take them if anybody has anything.
Hi, Professor Dyring. This is Juliana Taylor.
Hi.
I actually took your class when I was in the MS program back in 2012. Quick question. So when it comes to kind of contribution limits, so let's say I'm able to contribute through my employer to a 401k. I've rolled over money from prior employers into a traditional IRA. I can currently contribute to a Roth, but in the near future may not be able to. And so let's say I decide to take advantage of this non-traditional IRA. First question is there a limit as to how much I can contribute to this non-traditional IRA? Second question is, if I then convert it to a Roth, am I still subject to that same $6,000 limit, or does that change? And how does that impact my existing Roth if I already had one prior to trying to use this, I guess, backdoor method?
Yeah, great question. So if you have an IRA balance that exists because you converted, say, for example, a 401k when you changed employers, you probably have some gains built up in your IRA. If you try to then contribute to the traditional non-deductible IRA, you still are subject to the income limits of an IRA. So you can only invest in any given year, $6,000 if you're single, $12,000 if you're married. So those limits still apply. Then if you choose to convert, like trying to do the backdoor Roth, what will happen is you will need to take what's called a pro rata amount of gains from the new contributions and the existing balance from maybe what you converted from your employer. So that could get a little bit tricky. There could be some taxes. It can still be done, and you'd kind of have to sit down and see how much gain you have to see if it sort of works out or not in your favor.
Got it. And so you can't have an IRA and a non-traditional IRA at the same time. You have to have one or the other.
No, you can, but you just, when you convert, say, a portion of it, you don't get to choose whether you convert the portion with the gain or the portion without the gain. You have to average the gains, and then the fraction that you convert, you take the appropriate fraction of gains, and you have to pay tax on them.
Got it. Okay, makes sense. Thank you.
Yeah, great question. Anybody else? Thanks, Juliana, for your question, and thanks everybody for signing in. I will send out another email with topic for next week. My plan next week is to talk about how Salesforce managed to pay zero corporate tax on several $billion of pre-tax earnings. So Salesforce made a lot of money, several billion. They paid no corporate tax. I'm going to explain to you how that's possible And how they do it is similar to how many other companies manage to achieve this. So hopefully you'll find that interesting. We'll be here next Wednesday, 10 a.m. If you have not signed up, there's in the invitation for this, there's a little link. You can get your email on my list. I'll send out the topics and maybe an article or two that you can read in advance. And I look forward to seeing you next week. Talk to you later.